Hi everyone. Today we're gonna talk about comparison of S&P 500, SPX, and HSI, Hong Kong Seng. We're gonna see why there's a divergence between these two indices, and is it a potential investment opportunity for Hong Kong and Greater China or not? So what happened was in February 2021, there was a crackdown on some of the Chinese tech stock. And when that crackdown happened, it was here. When that crackdown happened, we see Chinese stocks, Hong Kong Seng went down and S&P went up here. So the reason was people were afraid that there would be more and more regulations against Chinese tech stock, and they would worry, like investors would worry that the China we knew the last 20, 30 years that was more of capitalistic front now is turning more towards socialist ideas and economic agendas. So people were afraid take their money out of the market, and Hang Seng went down. And that wasn't the only one that happened. When we get here further here to February 2022, the SPX went down, S&P 500 went down. And when the American stock went down, again there was a pressure on the Chinese stock to go down. So there was another pressure. And there was also recently the election of presidency there. That was also some drama there. Again, as you can see, there was a huge drop. It was the bottom at that time. Maybe it's the bottom, who knows? But so there was some drama there, and we had that. Uh, and throughout all this time, we had a zero COVID policy, and zero COVID policy didn't help anything. So most of this stuff that I mentioned solved. So, for example, the tech crackdown finished. They just find some of these tech stock, Tencent, Alibaba, NetEase, some other ones. They just find them and they pay the fine and they just continue doing their jobs. Zero COVID is dismantled. They're not gonna go with zero COVID anymore. And also, the election finished. The new president is gonna serve next 5 years. So most of the risks are off now, but the only risk is how this opening up and shifting away from COVID zero policy um is gonna evolve, because there's a chance that would be explosion of cases and some issues, and the healthcare system couldn't handle that. But overall, there's a high chance they could handle that. So as you can see, we have a huge divergence between these two, around 50%. So what's going to happen when we have this 50% divergence between these two entities? Like, if you invest here, maybe 100%, you're gonna benefit from it. So the most likely case scenario is in 2023, we're gonna have a weaker American equity market, American stock market, and we're gonna have a stronger, maybe uptrend Chinese market. So it's a good time to enter the Chinese market, because in next 1 2 years is gonna outperform the American market because the US market is a little bit expensive at this point. Um, and Chinese stock also have its own um, risks. You have to follow the news and see what's the evolvement. Some of the news that you hear, there are many of the news are mostly like a hyping up news. Those are not the real fundamental issues with the country. The real fundamental issues could be something that the trade war or some other issues happen between US and China, and this idea of delisting Chinese stock come up again, and that would be one risk, fundamental risk. But overall, uh, if you invest in those funds that are ETF, your exposure is gonna be less risky. For example, one of those ETF is that KWEB, Chinese tech stock. As I told you, because there was a crackdown on tech stock, the tech stock did actually perform worse than the rest of Chinese stocks. So probably KWEB is good. There are some other ETFs that they have exposure. I think there's another one, Golden Dragon. Yeah, I think another one is Golden Dragon. PGJ, I think. Yeah, could look it up. China Golden Dragon. I think is PJG. I don't know. Just look it up, guys. Uh, that's another one you could invest on it. So with the ETF, you have better exposure, and if you have a broker, some of the broker offer the same stock that listed in Hong Kong. For example, I think I heard some of the brokers they do that. For example, Alibaba is listed both in the US and in Hong Kong. So, in order to be immune from this risk of delisting, you could, if your broker offered that, you could just purchase Alibaba in Hong Kong stock. Um, and you have to know that although these stocks have risk, also American market has lots of risk too in 2023. Some of the risks that you're gonna face probably is the financial instability, as you can see in crypto space. You see more and more exchanges are collapsing, so that could be contagion and uh, go to other area and issue make some issue for financial instability, and that would be disaster because in that case Federal Reserve should come in and cut rate to bring back stability, and still the inflation is high. So that would be a very bad situation. So you guys do your due diligence on that, and have some exposure probably to Chinese stock. Please write your comment. Take it with care.